Well, happy Monday, everyone. Welcome to our Straddles and Strangles webcast. I'm Connie Hill. I'm glad you joined me here today. You know, this can be a very popular strategy as we go through earnings. And of course, we are in earnings season. How many of you are familiar with something we call the January barometer? The January barometer is something that has been published for many years by Stock Traders Almanac. We're going to talk about that a little bit today because it might be helpful to keep in mind as we see how the month of January progresses and what that might mean for the rest of the year. All right, so hold on tight, and we'll get to that probably pretty quickly in the beginning of our discussion here. I am joined in the chat by Cameron May. I'm glad Cameron's here, fellow coach and friend. Very knowledgeable in the markets. He's been doing this stuff for a long, long time. As you have questions, go ahead, chat those in. I will pay attention to the chat. Cameron might catch some of those things I can't quite get to. I also hope you're following us on X. Cameron's put our handles out there. Connie Hill CS, Cameron May CS. We'll post educational content throughout the week. So let's get going here. Let's go through our disclosures. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes only. Don't consider it a recommendation. We're going to be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim. Although you might also consider using the mobile and web versions. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right, I want to put in just a quick reminder here about upcoming events that if you're anywhere close to these or can get there, you probably will really enjoy it. I shouldn't say probably, you will totally enjoy it. Bellevue, Washington, we haven't been there for a while, so that'll be nice. Sacramento, it's been even longer since we've been to Sacramento. Those of you in, say, Northern California. And then we'll be doing a San Diego Market Drive event February 28th. Okay, so if it's convenient, we treat you really good. I'm surprised how good we treat you with food and pay your parking and give you little goodies. Man, we just spoil you rotten. Anyway, if you're interested in that, please attend. Typically, what we're going to do in this class, we want to look and see what the market's doing overall, right? It gives us an idea of maybe what our perspective of the market is. And then we're going to be talking specifically straddles and strangles today. In the feedback session, we did a survey a couple of weeks ago. And in that survey, somebody said, you know, I really just want to learn the vanilla straddle, the vanilla strangle. So we're going to kind of go back to that a little bit here today. All right, let's hop on over to Thinkorswim. And I will say there was a couple of questions that came in here early. Somebody's joining us from India. Ooh, man, they are up late in the coffee shop is what they said. And so welcome all of you, as well as folks maybe joining us from India or wherever it is you're joining in. All right, here is the SPX. I want to talk a little bit about this January barometer. Stock Traders Almanac has been collecting statistics and publishing them for years. They are not a Schwab affiliate in any manner, okay? But they do publish some interesting statistics. And one thing that has been well documented is what they call the January barometer, which basically is however goes January, maybe the rest of the year goes. And I think that's about 87% of the time. If we have a positive January, then 87% of the time since 1950, I should say, it has been positive at about average gains for the year of about 12%. Now, this in no way indicates that this is what will happen this year, right? We know that. There's another little thing I wanted to point out here. As we look at that, I've got these labels up here to the top. Year to date, I do not know why our year to date and month to date calculations are a little bit different from each other. Okay, but month to date, January so far, we're up 1.56% on the SPX. So we'll see if we end there, right? We've got a few more days the rest of the week, so we will see how that goes. Now, we talked, not necessarily in this session, but some of my other sessions, we talked about the Santa Claus rally. And if we were going to have a Santa Claus rally and what that meant, blah, blah, blah. Okay. Well, if we have a positive Santa Claus rally, then it's more likely that we will have a positive January. Okay. So the Santa Claus rally is the last trading days of the week or the year, plus the 2 beginning days in January. So I have put this lovely gray box here showing us where the Santa Claus rally took place. Started here on the 24th of December. And guess what? We did not, it was kind of a lackluster Santa Claus rally. Did not really do a whole lot. Did not, I mean, if we're technically looking at the numbers, it did not close positive. Okay. So could that be an omen for January? We'll see. Okay, right now we're up on the year. We'll see how that goes. The first trading day of January was right here with this red candle. And you can see where we are right now with respect to that still in January. Now, some of you may not have these scripts that you might be interested in, so I'm going to share those with you. So the first one we're going to share is the labels on the chart, these performance labels. Maybe I should have left that a little bit wider. There we go. We'll grab that. And we will also be using a script here called the Market Maker Move. This is more of an advanced class, so I'm going to assume you know a little bit about scripts. I'll know how handy they are, how to use them, and so forth. Anytime we share any scripts with you, remember they are not guaranteed as to accuracy or timing. All right. Shared those with you there, those of you that don't have it. All right. Let's take a look here at just kind of a vanilla look, okay, at something. I'm going to go ahead. I'm going to take you over to our monitor tab for just a moment. I put on some trades that we did not do in class. Now, we had Martin Luther King Day last Monday, so we did not meet. I hope you enjoyed the day off from the markets. It's always kind of nice to have a little bit of a break, isn't it? But I did put some trades on Friday for us to just kind of watch, okay? So let me explain those, and then we'll get into our new trades. First trade here, Airbnb. They do not announce their earnings until, let's see, February 12th. Okay, so we're about 3 weeks out on that one. Why in the world would I buy a long call and a long put? Why would I buy what we call a straddle? One thing that happens many times, although it's not always the case, but many times going into earnings, stocks implied volatility will ramp up. So if we come over here, let's put in our A, B, and B. That's a little bit A, B, and B. Let's see. That's not what did that come up with. I've got to get my fingers on the right keys. Good grief. There we go. Here's our Airbnb. And so many times going into earnings, even though it's clear out here, implied volatility has many times ramps up. That means option prices get more expensive. That means the implied volatility portion of the premium kind of inflates a little bit. And so sometimes, not always, but sometimes both the call and the put ramp up. Now, if there's real strong direction, then that will override just the implied volatility rising if the stock kind of stays where it is. However, it's interesting. We just got in this on Friday. Airbnb has not done a whole lot, right? This is what it looked like Friday. Here we are today. And just on those two contracts, we're up a little bit. And so some people will use that, kind of that little ramp, to maybe see if they can generate some profits. Okay, so we're going to leave that in there. We're going to watch it with the intent of just kind of seeing what happens with those two strikes before the announcement of their earnings. Oh, option 66 wants to know about the income of our Wells Fargo trade placed earlier. I told you we would do that. We will do that. The other two trades I have on here are not plain vanilla, okay? They are called a straddle strangle swap. What is a straddle strangle swap? I'll show you with Tesla, and I did the same thing here with WDC. Tesla has earnings this week. Theirs is on Thursday, I believe. No, the 28th, after the market closes. So that'll be Wednesday. So we'll see the results of it and the reactions to it pre and post market, as well as, okay, Thursday will be the first full trading day with that knowledge out there. And so what we've done here is we took the options that expire this Friday. We took the straddle, whatever the straddle price was on Friday, 447.50 on the call and the put. We went ahead and sold those because implied volatility is high. Our intent is to capture that. And then for our protection leg, our hedge leg, we have out here to protect us, especially when you're doing a naked call, but different risk on a short put, but there's risk when we're short those options, right? Then we bought a little bit of insurance a couple of weeks further out, okay? So this one generated a credit of $8.10. And so we're going to see how that plays out. I did not put the trade on in class, as I told you. I just put it on Friday because I wanted us to have some additional things to be watching. All right. Same thing on Western Digital, straddle strangle swap. If you're maybe a little bit more advanced, then you might go, maybe I'll put this example in my own paper money account so I can follow along, see what questions I have as we do the trades. Okay. All right, that'll also be true with our new trades we put in. Let's look at Wells Fargo here. Wells Fargo got a little weird on us. Wells Fargo, we did one of these straddle strangle swaps. In paper money, you'll also see that termed a double diagonal, which technically it is, because we have options of different strikes and options of different months that we're putting together, which is a double diagonal. So on this straddle strangle swap of Wells Fargo, we put that on the 12th, and we brought in a little bit of a credit. And I'm going to show you kind of what the chart looked like. We put the trade on here. They announced their earnings the morning of the, whatever this date was, the 14th. And so the reaction to the earnings obviously did something pre-market, but we had this big gap down and then it continued to drop. Okay. So initially we're like, okay, it had a big move like we were expecting Wells Fargo to have the big move. In terms of our numbers, kind of a funky thing happened. We brought in our credit the day after it started trading with the news, about an hour, 27 minutes into, almost an hour, okay, 8:27 into the trading day. It was looking like that our short put was not going to be doing what we needed it to do. The short call was in good shape. So we went ahead and we closed out the short put side of this one, okay, which cost us $5.10. And so sometimes how I look at this, I mean, the net is going to be the net, but basically we're saying, yeah, we need the rest of these legs to make up for what we took in a loss. Now, a little bit later that day, at 9:26 my time, which I'm on the mountain time zone, so then the market's been open here almost a couple of hours. I wanted to close out some of the other legs, and what was interesting is that it went and grabbed this leg here that we had already closed out. This 94 put, it went ahead and it kind of kept the structure of the original trade. And I didn't notice when it was time to close out. I picked the top option, I think, that should have everything in it. And I was expecting there to be 3 legs in there. And there weren't. So it kept this 4th leg in there. It kept that structure, even though we had closed this out. So paper money sometimes is not perfect. Is really helpful, is really good. And then later in the day, I was like, why do I still have that 94 put on there? That was the first one we closed out. Okay. And so it put it in this closing out trade and left it there as a loan option. And so I was like, oh, well, let's just go close it out. We didn't mean to be in here. We'll go close it out. And the price actually is kind of almost break even here. Okay. 510 to close it out, 515 to go close it out the second time when it got wrapped up in this trade. Okay. Now, option 66, I don't know how your numbers fell. I don't know how you did, or anybody else for that matter, because somebody could have continued to hold on to, say, the short call spread, kind of milk it a little bit more. This was, I believe, a Wednesday, so we'd have Thursday, Friday, and then that front week would expire. So, yeah, Paul says paper money will sometimes double fill. Yeah, that's kind of what happened there. Kind of a weird, fluky type of thing. But that's how Wells Fargo went. All right, let's take a look at some new opportunities for this week. Now, there's a ton of earnings coming out. There were so many things to choose from as far as potential stocks. Now, the ones that we are going to go with, we're going to go with for a couple of reasons. Number one, they've moved pretty big in the past. And number two, there is a ton of implied volatility priced into the front week. So the first one we're going to take a look at now is ServiceNow. And I want to take us back a year and just kind of see, okay, there's our year. Let's kind of see if it has moved big or not over earnings. I'm going to zoom in on this first one here, but you can see, well, maybe I won't. You can see that this gap down. And that's one of the things we look for. We look for gaps and we look for long candles. That tells us if there was some big movement. So on here, stock closed here, big old gap here, definitely dropped. Okay, so it was a big mover then. Let's fast forward here to the next earnings announcement. Boom, here we go. They announced here, started trading big gap up and a big gap, a little bit of a run afterwards as well. On both of those moves, it didn't move a lot afterwards, but this initial movement, yeah, it definitely did. Next up is, we'll go to the next earnings real quick. Not as big of a gap, all right, but definitely a gap because it closed here, it opened up here, which was huge, but then it started to fall. So it doesn't always necessarily continue to run the same direction that it gapped to. And then the last one, let's see how October did. October is kind of interesting because there's not like a big gap, but look at the volatility on this day. Yeah, I mean, it closed here, so opened here the next morning, or actually right here, closing price or opening price would be here. At one point ran clear up here to 190, almost 193, and then the low was 179. So look at the volatility that day. That would have been a little bit difficult to trade because many times you think the first direction the stock goes is the way that maybe the trade is going to play out, but that's not always the case. And in this case, maybe if earlier in the day it ran up, you might have gone, oh, well, let's get rid of our long put there, right? If you had a straddle going on, let's get rid of long put. And then later in the day, it drops clear down here. Then you're down on your call side and you're thinking, oh, I wish I still had that put when it was down there. So days like that with big long ranges make it really tricky. Okay, really tricky. So it is a potential candidate here. Now I've got the market maker move. As a reminder, what is this market maker move? Well, it's basically what is priced into the at the money option prices. Okay, as far as expectation, what is priced in there. And so what we look for is this, a lot of them are weeklies, or sometimes it'll just be a front month. Is there a big difference between This number here, 91%, and then where it drops down to after earnings is out. Yeah, 63%, 50, 56, and then down to the 50s, the 40s. Man, there is a lot of implied volatility priced there. So you might have one approach. You're like, we're either going to be buyers or we're going to be sellers. In this case, it might be really tempting to be a seller. But if this thing like really moved beyond boundaries, that could be a little bit tricky. Okay. So what we're going to do here on this one, they announce on Wednesday night. And then that means the first day of trading will be Thursday morning, but we should be able to see what the reaction to the after hours market is, right? By taking a look at that chart, either before the market opens the next day or if you're following it that afternoon after they announced. All right. But the yellow one here is that market maker move. That's kind of shows us, oh, it's that 7.11%, which is grabbing from the trade tab. Expected movement is $9.59, either up or down. We don't know what direction it's going to go, right? And so we're trying and attempting to play both sides of it. So as we come down here to the chart or to the trade tab on now, we are going to do, we're going to do a strangle here. This is kind of going back to the idea that you wanted to see the vanillas, okay? Some people might opt for selling the straddle or the strangle here because this is so high, but we're going to just do a strangle a little bit out of the money. Now, straddles when you're right at the strike price. So our straddle, if we were doing that, would be the 135, which is almost straight on what the price of the stock is right now. With a strangle, we go a little bit out of the money, okay? You might make guidelines as far as how far out of the money you go. You could go one strike, you could go two strikes. We do have the single dollar increments here, which is a little bit nice. So what we're going to do here, we're going to go out 3, okay, because we have the single strike prices. So we're going to come up here. Since 135 would be our at the money, we're going to go 1, 2, 3. So we're going to do the 132 put. Okay, so I'm going to go ahead. I'm going to queue that up. I'm going to hold down my control key so that it knows we're going to put some other things with this. Okay, right now this is just the single. And then same thing here. We're going to go 1, 2, 3 out of the money. And that one's going to be our 138 call. Okay, so hold down the control key. Go ahead, put that in. So this is an expensive trade. And we look at what the debit is here, and many times it's going to be pretty close to what that market maker move is right up here. It's not going to be perfect or exact, but it's going to kind of be in the same area, which makes sense because that is basically from, like if we, I misspoke here. I misspoke here. What's interesting here is that it does add up close to the market maker move. Generally, what we'll find is if we did the 135 on both sides, sometimes that'll equal the market maker move. It'll still be in that same ballpark. So interesting, this is close to it as well. If we did the straddle, it would be more expensive than that. What, it would be 540 plus 560. So we'd be looking at $12 if we did the straddle. So when we do the strangle, it's a little bit less expensive on us, but it does kind of spread out our boundaries a little bit more because we want the stock to move, in this case, at least $8, because we're going to plan to lose one side and the other side we're expecting to gain on. But come announcement, right, that implied volatility is going to come crushing out. And so that's why we really need the big move on it. So let's go ahead. We're going to put this one in, and we're going to put it in our class bucket. And we're just going to do one contract each. Your portfolio might allow you to do more, which is just fine. straddles and strangles. So we're going to keep an eye on this Wednesday night. All right, we got filled on that. Let's go to one more here. Let's go to stock that you might be familiar with. Maybe you even visit an establishment of this organization daily. Some of you might. Starbucks. They are due to announce, and theirs is going to be the 28th, but before the market opens. So if somebody wanted to be in this trade for the earnings, they would want to be in buy before the market closes on Tuesday, because they'll announce Wednesday morning. Okay. Is Starbucks a big mover over earnings? Well, it has been. Let's kind of zoom in here. So this is back last January. It closed here, a little bit of a gap, but a good run throughout that day, man. That it was like a little gap and continued to flow. Interesting. Okay, let's check out the next one. We'll just fast forward here another quarter. And in another quarter, closed here, gapped clear down here. Okay, so that's a good sized gap, but it didn't continue to drop, did it? It actually started to rally. So in something like this, say you had done a straddle or strangle, in an ideal world, which after the fact, it's always easy, right? Oh, well, it's after the fact. We see what the full candle was. We saw what happened after the fact. But this is one where it would have been a little tricky. And ideally, to get the most out of it, you probably would have needed to have let the stock drop, cash in your long put, whether it was for a straddle or a strangle, and then some people might have even sold the call. They're like, oh, it's not going that way. Get rid of the call first, and then you can let. I take that back. Get rid of the put first because we're long on it. This is down, and you can see how that worked. All right, I think I may have twisted that there. So we'll get it straight here. Next one, Wild Mouse here, was not a big mover for the initial gap. I mean, it was a gap, but look at the volatility again here. So that can happen where, it's just kind of all over the place. Okay, it's definitely a mover. How about, let's see here. Oh, Paul has a question there. How do I get the red bar, the chart where it shows the year-to-date, month-to-date, all of that? That is in a script I shared at the very beginning, which I'm happy to share again. Okay, I will share that again. It's called the performance labels. Well, that's what I call them, performance labels on the chart. Remember, anytime we share the scripts with you, it's not guaranteed as to accuracy or timing. You really just need the URL. You don't need my little thing there that says performance labels, but I like to keep track of what those scripts are that I have on there. Avi says, now, given that how the stock runs over a couple of days, do you recommend exiting in a couple of days? You're going to have to track that. Excuse me, just had a little tickle there. You'll have to track it. Many times it's time for the trade to unwind pretty quickly. Okay, like say this drop on Starbucks here. A lot of times you'll see what that initial movement is, and I'll say this: if you are happy with your profits, you might take them. Might be that same day. It might be 5 minutes after the market opens. Might be a little bit later in the day or the next day. So there's not necessarily a, hey, you'll probably get out of it within X number of days, but you'll be monitoring it. And if you know the direction can change fairly quickly, then that's when you might say, if I'm happy with what I made on this initial move, you might just cash it in and call it a trade. Because as we're looking at these, you can see, man, it changes quickly, right? Like on this one with the big gap down, Oops, I didn't, I zoom into the wrong spot. I think I did zoom into the wrong spot. Let's come back out here a little. This one, this is the one in April. You might have been happy at that first gap down. You might have gone, okay, yeah, let's close the trade out here. Some people might have let it fall a little bit longer, and then maybe if it started to rally, do that. Or they may have said, I'm seeing it rally here. If it makes a big candlestick, maybe that's all I'm going to get out of that long put. Okay, so it is just you got to watch it. Some people will put in targets that they say, hey, if it makes this much money for me, I'm out. I don't care if it goes more. I just want to capture maybe this part of it. Okay, so there's a lot of different strategies you can use to exit on it. It's not a set, oh yeah, after 2 days you're going to be out. Not always the case. Okay, hopefully that helps. Those of you that are listening to this on a recording, I should do something for you real quickly on the chart. I'm going to do a text message, or not a message, just a text box, and I'm going to copy in these scripts for these two, the market maker move and the performance scripts. Darn, I should have copied that first. Here we go. Then I'll put it in the text box. And then if you're listening to this on the recording, you're trying to get that, go ahead, pause it, take note, get that what that URL is, okay? Now let's head over. Market maker move here's close to 7%. Earlier today it was 7%. Let's go to the chart or the trade tab, look at, is implied volatility baked into that front week? Whoa, is it ever, right? 90%, and then the next one down 64%. So a lot of implied volatility. What, like 25% more implied volatility in that front week? Okay, so is it a big mover? Yes. Is there a lot of implied volatility priced into those options? Yes, because there's the expectation of movement. Now, again, you look at that, you could either be a buyer of it or a seller of it, okay? Typically in our class, when we've been doing the selling of that front week, that's why we buy the hedge legs out. We'll do like a short the straddle, so the at the money, and then we go a little bit further out, either 1 week or 2, and then we'll buy those hedge legs, okay? So on here, because we're doing plain vanilla, this one I was going to do just a straight straddle, okay? Current price, 96.60. That means 97 is going to be our at the money strike price. So we're going to do it on both legs, the call leg and the put leg. So there's our call leg, or put leg rather. Now we'll grab our call leg. So it's going to cost about $7.28. So we really want to see, movement here, okay? Again, strategy, getting out of this. One, we're going to watch it when the announcement comes out. And this one we said was the morning of the 28th. So if you can be out here and you can go pull up your charts, let's go ahead and submit this. Let's go to our straddles and strangles here. That night, what do? You bring up Starbucks. You come over here. I'm gonna get rid of this label here, guys. This is was for that short moment. We're gonna come up here. We're gonna say we're gonna grab a 1 minute, 1 day chart. And then what we're gonna make sure we're gonna do is we're gonna go into that gear, come over here to equities, and then make sure you've got these boxes. Show extended hours trading session. That's what we want to see, right? We want to see the hours after the market close or the market opens. That's where we're going to see it that morning before the market actually opens. And then I have mine set to highlight the extended hours trading session just so you know what it is, right? So it'll do it in gray. So this is Friday, where all this black is. This is Friday. And then the gray is what happened in the post-market and the pre-market, which is not a whole lot, okay? Nothing really going on with this yet, but when they announced earnings, that's where you're going to be looking. So if the initial indication, say, is a gap up, then we might go, okay, if it's a significant gap up, the first thing we might do is say, make the decision, we're going to hold on to the call, let's go sell the put. We're expecting to lose most of the value in that put. Now, if it's not a very big gap, if it's not a really big move, you might be able to salvage a little bit more out of that put, but just know we're not expecting it, okay? That's why we are looking for the move to be at least as much as what we spent on the trade, okay? That's the kind of move we need to be looking for. What if it gaps down? Well, if it gaps down, you might make, if it's significant, say it's, what is going to be significant? $1, you might be needing to hold on to it for a little bit. You might be needing to go, let's see which way it really is going to go, because $1 one way or the other is not probably that big of a deal. And so you'll be waiting for the stock to tell you what direction is the market going to react. And then once you have that and you're like, okay, finally, this is what the market is doing. It's decided that maybe it was down $1 and then it drops down $2, $3, $4 more bucks. You're like, okay, now the market has made a decision. Let's go ahead and sell the leg that doesn't make sense to hold on to. So if it dropped, you'd go out, you'd sell the call for whatever you can get out of it. If you paid, you're not going to get much out of it. I hate to blow your bubble, but it's not going to be worth that much, right? Because there's not much time value left. It's going to close, those options are going to expire on Friday. The implied volatility will come crushing out. So that's why I'm saying don't expect a lot from the leg that you're going to lose on, okay? A little bit is very helpful. Okay, so it's just going to depend on what that stock does. You have to pay attention to these trades. Don't plan on that morning just taking a peek pre-market and then go golfing. Of course, it's not really golf weather in most places, but don't go skiing all day, right? Because you'll miss out unless you put an order in to execute for you. And that's something that some people will do. They'll say, hey, I'm just looking for some profit. Okay, our premium here's totaled how much here? $725. So somebody could go in and say, well, if the call gets to $725 plus, get me out. Or if it goes to $97 minus $725, what that turns out to be, right? A little bit less than $90. I mean, people could put some orders in there to execute if they're like, I would be happy with X. So I hope that makes sense to you, just kind of going through maybe this, maybe that, maybe this. John says, how about the Starbucks for a straddle or strangle? You may have chatted that in before we actually did the trade. So we decided to do the long straddle because we're just going kind of back to some vanilla today versus a little bit more involved where we were doing the shorts and then putting on a hedge with it. When is the market maker move calculated and is it updated? Now, it'll be updated. Great question, Harry. It'll be updated all day long, that market maker move will. Because when I looked at it early today, when I decided on Starbucks, the expected move was 7.62%. And now it looks like it's dropped a little bit to 6.6. I take that back. This is the dollar move. The dollar move this morning was 738. So it is down a little bit now. It's down to plus or minus $6.60. So it is updated all day long while the market's open. It'll continue to update. But if it's a pretty decent sized number here, then it probably is not going to vary a lot. Meaning, if it's at 6% right now, more likely than not, which I shouldn't really speculate, but I would not expect it to all of a sudden tomorrow be down at 1 or 2. Whatever this number is, generally speaking, yep, there's a lot of implied volatility priced into the assumptions. Okay. Abby says, what has been the rate of change on these in the past? I think that's what you mean by the ROC rate of change. It varies totally across the board, which is why we went out and showed what has this stock done this year in every quarter that they've announced. What did they do? Did they move big? Did they move small? Because typically for a long straddle or a long strangle, which we've got one of both, we need big moves and we want to see big moves. If we did not see that historically, they're probably not a good candidate to do a straddle strangle on, right? If they don't typically make big moves. Yeah. RB Track Trader said, would it make sense to turn the straddle into 2 vertical spreads? And I'm going to say you're thinking maybe you could trade it like an iron condor with 2 credit spreads, but since this is not credit spreads or any option strategy will do, we just strictly stick with our straddles and our strangles here. All right. Let's run through just a couple of things here. We've got quite a bit on our plate that we're going to keep an eye on. I'm going to be really busy Thursday morning. I'll tell you that. Okay. We're going to watch Airbnb to see what happens, see if it inflates. They don't announce until February 12th. Here's our trade we just put on now and our trade we just put on Starbucks. Again, a little bit later this week. Now is Wednesday night, Starbucks Wednesday morning when they will announce. And then I've got these couple of more detailed trades, Tesla and WDC, that are straddle strangle swaps, where we sold the front week, but we bought some protection a little bit further out, February 13th. And if anything exciting happens here, I'll be sure to share it with you next week. All right. I hope you've become a subscriber to our Trader Talks channel in YouTube. It just makes it so much easier to find our information. What are we doing? What's coming up? So here's our straddles and strangles that we're in right now. So Barb Armstrong, she'll be up next right at the top of the hour with trading a smaller account. I know there's a lot of you that love going to Barb's class for that. And James Boyd's going to be after that, trading with technical indicators. Now, Cameron, let's see, Cameron's here today. He's out in our chat. Let's see, his is going to come up after James, after trading with technical indicators, covered calls, and short puts. Now, if you go to Cameron's class, he may very well teach, he could very well do something that you were expecting here. What if we do a different kind of trade on this? Maybe Cameron will cover something like that in his class. Of course, not guaranteed. I can't read Cameron's mind. But just the idea that, yeah, he's going to be focusing on these other strategies that we're not focusing on in this class. All right. So find our content right here, makes it easy. If this is helpful to you today, smash that like button on the way out. That lets other people know that you found it useful and helpful. You could be doing a favor for somebody else that you don't even know. It helps in the algorithm there. I think we're able to catch the questions along the way here. If I missed anything, feel free to message me in my X account, Connie Hilsias. Send me a message there about it, or respond to the class once it's posted. You can put questions in the comment section on YouTube. Those are the questions I go out and answer throughout the week. Okay, so if you have a question there, feel free to throw it in there. All right, you guys, my time is out, so I'm going to zip my lips here in just a moment. Appreciate you being here today. Cameron, thank you for your help out in the chat. You guys had some fantastic questions. And again, paper trade these if there are strategies you're like, I kind of want to get a feel for. Yeah, that's why you paper trade them. Going through these couple of examples might help you out so that as you are kind of trying to monitor and manage them, then you know what questions come up so that we can discuss them next week. All right, you guys have a great Monday, and I'll see you back here earlier in the week, but for sure we'll revisit these trades next Monday.